In 2023, central banks around the world bought 1,037 tons of gold, the highest level in 55 years. China bought 225 tons. Russia bought 200 tons. India bought 150 tons. Poland bought 130 tons. Singapore, Turkey, Czech Republic, all buying gold at record pace. These are the institutions that control the global monetary system, the ones who print currency, the ones who set interest rates, the ones who manage reserves, and they're converting paper currency into physical gold as fast as they can. Meanwhile, their economists appear on CNBC telling you to buy stocks. Their financial advisors tell you gold is a barbarous relic that generates no yield. Their central bank governors say the dollar is strong and the system is stable. But their actions tell a different story. Ray Dalio, founder of Bridgewater, the world's largest hedge fund, holds 10% of his portfolio in gold. He's been buying since 2018. He calls it insurance against monetary chaos. Warren Buffett, who spent 50 years calling gold worthless, now owns $1 billion in Barrick Gold stock. He bought in 2020 and hasn't sold. Stanley Druckenmiller bought gold in 2022. Paul Tudor Jones bought in 2020. Bill Ackman bought in 2023. These aren't gold bugs. These are the most sophisticated investors on earth, the ones who made billions predicting every major crisis. And here's the signal you need to understand. J.P. Morgan Chase holds 389 million ounces of physical gold in their COMEX vaults. That's $500 billion worth, more than any institution in history. But J.P. Morgan's wealth management division tells clients that gold is a poor investment that doesn't generate returns. They're buying gold. They're telling you not to. What do they know that you don't? The answer isn't complicated. It's pattern recognition. Because this exact scenario has played out 4 times in the last 500 years. Every time a reserve currency dies, the same pattern emerges. The people who control the system start buying gold. The public keeps buying paper assets. Then the currency collapses, paper assets evaporate, gold survives. And we're in the final phase right now. Let me show you the 3 moments when the gold accumulation pattern revealed what's coming, why central banks are preparing for the collapse of the system they control, and why your stocks will be worthless when the moment arrives. Moment 1, 1971. Nixon closes the gold window and starts the countdown. Before 1971, the global monetary system was based on gold. The Bretton Woods Agreement, signed in 1944, made the U.S. dollar the world's reserve currency. But the dollar was backed by gold. $35 bought 1 ounce. Foreign governments could exchange dollars for gold at any time. This created discipline. America couldn't print unlimited dollars because foreign governments would demand gold redemption. The money supply was anchored to physical reality. But by 1971, America had a problem. The Vietnam War was expensive. Social programs were expanding. The government was spending more than it collected in taxes. And to finance the deficit, they printed dollars. France noticed. Charles de Gaulle, France's president, saw that America was printing dollars far beyond their gold reserves, so France started exchanging dollars for gold. They sent warships to New York to collect it. Other countries followed. Germany, Switzerland, Netherlands, all demanding gold. By August 1971, foreign governments had redeemed so much gold that U.S. reserves were dangerously low. At the rate of redemption, Fort Knox would be empty by 1973. President Richard Nixon faced a choice: stop spending, raise taxes, and defend the gold standard, or break the link between dollars and gold, print unlimited currency, and hope the world kept accepting it. On August 15, 1971, Nixon closed the gold window. He announced that the U.S. would no longer redeem dollars for gold. The Bretton Woods system was over. The dollar became pure fiat currency, backed by nothing but trust in the U.S. government. Nixon called it a temporary measure. It's been 53 years, and here's what happened immediately. Gold's price exploded. In 1971, gold was $35 per ounce. By 1980, it was $850, a 24x increase in 9 years, because the smart money understood what Nixon's decision meant. Without gold backing, there was no limit to how many dollars could be printed. The currency would debase. Inflation would accelerate, and gold was the only asset that couldn't be printed. But the public didn't understand. They kept their money in dollars, in bonds, in savings accounts earning 5% interest while inflation ran at 13%. Their purchasing power was destroyed, while those who bought gold preserved their wealth. This is the first pattern. When currency detaches from gold, those who understand monetary history buy gold immediately. Those who don't lose everything. And here's the mechanism that makes it inevitable. Once a currency becomes fiat, the government always prints. Always. Because the political pressure to spend is greater than the discipline to restrain. From 1971 to 2024, the dollar's purchasing power has declined 87%. A dollar today buys what 13 cents bought in 1971. But gold hasn't declined. Gold is still gold. 1 ounce in 1971 is 1 ounce today. And priced in dollars, it's gone from $35 to $2,000. That's not gold going up. That's dollars going down. Nixon's 1971 decision started the countdown, and the people who understood it bought gold immediately. But the next moment revealed something even darker. Moment 2, 1999-2008. Central banks sell gold at the bottom, then start buying through the 1980s and 1990s. Gold was in a bear market. The price fell from $850 in 1980 to $250 in 1999. Central banks and economists declared gold obsolete. The future was paper assets, stocks, bonds, derivatives. And central banks started selling their gold reserves. From 1999 to 2008, central banks sold 13,000 tons of gold. The Bank of England sold 395 tons between 1999 and 2002 at an average price of $275 per ounce. Switzerland sold 1,550 tons. Netherlands sold 500 tons. The IMF sold 400 tons. Gordon Brown, UK Chancellor of the Exchequer, announced the sales in advance, told the market exactly when the gold would be sold. Prices dropped further. Brown sold at the absolute bottom, $275 per ounce. Today, gold is $2,000 per ounce. The UK lost $8 billion by selling at the bottom. The decision is called Brown's Bottom, the worst investment decision in British history. But here's what nobody asks. Why did central banks sell? The official story was that gold was a non-performing asset. It sat in vaults generating no return. Better to sell it and buy bonds that paid interest. But the real reason was more sinister. Central banks needed to suppress gold's price because rising gold signals currency weakness. If gold went up, it meant people were losing faith in paper currency. That would cause panic, capital flight, and system instability. So central banks coordinated sales to keep gold prices low. They signed the Central Bank Gold Agreement in 1999, limiting sales to 400 tons per year. But that was still 4,000 tons over 10 years. The gold market is small. Annual mine production is about 3,000 tons. Adding 4,000 tons of central bank selling overwhelmed the market. Prices stayed suppressed. This is the second pattern. When central banks sell gold, they're manipulating the market to protect their currency system. But then something changed. In 2008, the financial system collapsed. Lehman Brothers failed. AIG needed a $180 billion bailout. The global banking system was hours from total collapse. And in the panic, everyone reached for gold. The price went from $800 in 2008 to $1,900 by 2011. But more importantly, central banks stopped selling and started buying. In 2010, central banks became net buyers of gold for the first time in 20 years. They've been buying every year since. What changed? 2008 revealed that the system nearly died. All those sophisticated financial instruments, derivatives, mortgage-backed securities, collateralized debt obligations, they all turned out to be worthless when the crisis hit. But gold held its value. Gold couldn't default. Gold couldn't be downgraded. Gold was the only asset that survived. Central bankers saw this. They realized that when the next crisis comes, paper assets will evaporate again, and gold will be the only thing standing. So they stopped selling and started buying. And here's the signal that should terrify you. The people who run the monetary system, who control the printing presses, who set interest rates, they don't trust the system anymore. They're buying gold because they know paper assets are at risk, and they're positioning before the public realizes. Moment 3, 2020-2024, the accumulation phase before collapse. Since 2020, central bank gold buying has accelerated to levels not seen since the 1960s. In 2022, central banks bought 136 tons. In 2023, 1,037 tons. 2024 is tracking even higher. But here's what's different from previous decades. It's not Western central banks buying. It's China, Russia, India, Turkey, Poland, Singapore. Countries that want to reduce dependence on the dollar. China is the key. China's official gold reserves are 2,162 tons. But every analyst knows this is a lie. China has been buying gold secretly through state-owned banks and private channels for 20 years. Estimates based on import data, mine production, and scrap supply suggest China holds between 20,000 and 30,000 tons of gold. They're not reporting it because they don't want to signal their strategy. Why is China buying? Because they're preparing for the dollar's collapse. China holds $3.2 trillion in dollar-denominated assets, treasury bonds, agency debt, dollar cash reserves. If the dollar collapses, those assets become worthless. But if China converts some of those dollars into gold before the collapse, they preserve wealth. Gold is the only asset that will hold value when currencies fail. Russia has followed the same strategy. After 2014 sanctions, Russia sold U.S. treasuries and bought gold. Their gold reserves went from 600 tons in 2014 to 2,300 tons by 2022. They converted dollar assets into physical gold. When Western countries froze Russia's dollar reserves in 2022, $300 billion vanished. But they couldn't freeze Russia's gold. Gold held in Moscow is beyond Western jurisdiction. This is the lesson. Dollars can be frozen, seized, sanctioned. Gold cannot. And central banks are positioning accordingly. Poland increased gold reserves from 103 tons in 2018 to 360 tons in 2024. Singapore went from 127 tons to 280 tons. Turkey went from 116 tons to 540 tons. These aren't investment decisions. This is preparation for monetary system breakdown. Because here's what central bankers know. The dollar's reserve currency status depends on confidence. As long as the world believes dollars are stable, the system functions. But if confidence breaks, the whole structure collapses. And confidence is breaking. BRICS countries, Brazil, Russia, India, China, South Africa, are discussing a gold-backed trade currency. Saudi Arabia is accepting yuan for oil sales instead of dollars. Countries are negotiating bilateral trade deals that bypass the dollar. The de-dollarization trend is accelerating, and every country moving away from dollars is buying gold as the alternative reserve asset. Central banks are preparing for a world where the dollar is no longer supreme, and gold is the only universally accepted alternative. What the billionaires know. While central banks buy gold secretly, billionaires are buying openly. Ray Dalio has been warning since 2018, cash is trash, own gold. Stanley Druckenmiller said in 2023, I own gold because I believe the fiscal situation in the U.S. is out of control. Paul Tudor Jones said in 2020, I'm long gold, long Bitcoin. I want to own the fastest horse in the race. If inflation comes, gold will protect you. These aren't gold bugs. These are macro investors who made billions predicting currency crises. And here's what they see. U.S. debt is $38 trillion, deficits are $2 trillion per year. The Federal Reserve can't raise rates high enough to control inflation without crashing the economy. And when the next crisis hits, they'll print trillions more. The dollar is trapped. Too much debt to ever repay, too much printing to maintain value, too much leverage to survive the next crash. And when the moment comes, paper assets, stocks, bonds, cash, will collapse in value. But gold will survive, because gold is no one's liability. Gold doesn't depend on any government, any central bank, any corporation staying solvent. Gold is the only asset that exists outside the financial system. And when the financial system fails, gold is what's left. The pattern that repeats every 8,100 years. This pattern has happened 4 times in recorded history. Spain's silver-backed reals collapsed in 1640 after 200 years as reserve currency. Those who held gold survived. Those who held reals lost everything. Netherlands' guilder collapsed in 1720 after 150 years of dominance. Gold holders preserved wealth. Guilder holders were wiped out. British pound sterling collapsed between 1914 and 1971 after 200 years as reserve currency. Gold went from $4 per ounce to $800. Pound holders lost 99% of purchasing power. Now the dollar, reserve currency for 80 years, is showing the same pattern. Massive debt, infinite printing, declining confidence, and those who understand monetary history are buying gold. The average lifespan of a reserve currency is 94 years. The dollar became reserve currency in 1944. We're in year 80. The pattern says we're near the end. Why they tell you to buy stocks. Here's the final piece. J.P. Morgan holds 389 million ounces of gold. Goldman Sachs holds gold. Central banks hold 36,000 tons of gold. But their financial advisors tell you to buy stocks. Put your 401k in index funds. Stay invested in bonds, dollar cost average through volatility. Why? Because they need you to hold paper assets while they hold gold. When the crisis comes, someone has to lose. The system has too much debt, too many claims on too few assets. Not everyone can get out. So institutions position in gold. They tell the public to stay in stocks. And when the collapse happens, retail investors lose everything while institutions preserve wealth. This isn't conspiracy. This is the way wealth transfers work during monetary resets. In 1933, the U.S. government confiscated private gold, then revalued gold from $20 to $35 per ounce. Wealth transferred from citizens to government overnight. In 1971, Nixon closed the gold window. Wealth transferred from dollar holders to gold holders. The next transfer is coming, and the positioning is already happening. Central banks buying 1,000-plus tons per year. Billionaires converting billions into gold. Sovereign wealth funds accumulating physical metal, while retail investors are told to keep buying stocks at all-time highs. The truth they won't tell you. You're in stocks because you've been taught that stocks always go up over time, that the market returns 10% annually, that buy and hold wins. But that strategy only works when the monetary system is stable, when the currency survives. In 1920s Germany, the stock market went up 500,000% during hyperinflation, but measured in gold, stocks lost 97% of their value. Paper gains were meaningless when the currency collapsed. In 1990s Russia, stocks existed but were worthless after the ruble crisis. Those who held gold preserved wealth through the chaos. In 2000, Zimbabwe, stocks went to trillions of Zimbabwe dollars. But measured in gold, they were worthless. The pattern is clear. When currency collapses, stocks measured in that currency become meaningless. Only gold preserves purchasing power. And right now, the people who control the global monetary system are buying gold at record pace, while telling you to buy stocks. That's not investment advice. That's positioning before a collapse. If this changed how you see the disconnect between what central banks do and what they tell you to do, if you finally understand why they're buying gold while telling you it's worthless, then you're starting to see the end game. Subscribe if you want to understand what comes next and how to position before the public realizes. Because they're not going to ring a bell. They're not going to announce the collapse in advance. They're just going to keep buying gold, and when the moment comes, you'll understand why. But by then, it will be too late.